Hey traders, let's quickly take a look at the main macro event for the week ahead, which is of course Wednesday's US CPI. Now this one is going to be interesting for its possible implications on both dollar positioning as well as Fed rate expectations. Remember, going back to the FOMC's meeting back in December, they shifted a lot more hawkish than what the markets had anticipated, basically citing concerns over a re-acceleration in inflation as the main reason. So that means any upcoming US CPI data that we get will be a little bit more important than usual. Now we can see here that after the bank's December FOMC meeting, short-term interest rate markets repriced quite aggressively and now only fully prices in just one more cut for the FOMC by the end of the year. And of course, a very small premium for a possible second cut as well. Now, apart from rate markets, the FX market has also priced in quite a lot, with dollar positioning still sitting at its most stretched long positioning since 2017, as the markets have basically priced in a lot of bullish fundamentals for the dollar from a growth point of view, inflation point of view, policy, and obviously ongoing tariff risks as well. Now, why is all of this information important going into CPI? It's important because based on how markets are currently positioned going into the CPI, it means that a massive potential miss in CPI data could trigger a much bigger reaction in the markets compared to a beat. Now, don't get me wrong, this doesn't mean that a hot CPI print this week can't see upside in the US dollar. It certainly can, because a seriously hot print will basically justify the Fed taking a more cautious view on interest rate cuts in the first place. It simply means that for a short-term trader's point of view, a potential miss in CPI could just offer a much clearer directional play on the day. So what that means in terms of possible opportunities, it means that the lowest hanging fruit for short-term traders this week would be a punchy miss in US CPI and basically using that to either trade the dollar lower or things like equities or gold higher. Now that brings dollar CAD once again back into focus for us after the breakthrough that we had in recent sessions with President Trump basically postponing those potential tariffs against Canada. The dollar CAD saw a very strong push lower as anticipated and offered a fantastic opportunity for those who were fast enough to jump in on the news. Apart from that, Friday's jobs data for Canada also came in very solid. 76,000 jobs added after the 90,000 jobs added the month before, as well as a small upward revision. Also saw the unemployment rate ticking down to 6.6, which should be positive for the Canadian dollar. Furthermore, unlike the US dollar that is stretched on the long side, the Canadian dollar is still sitting on a fairly big net short positioning, the biggest going back all the way since 2018. And when we look at the options market with things like implied volatility as well as risk reversals, we can see both of these two measures have pushed lower considerably as the market have started to price out some of that tariff risk or fear. All of this basically favors further potential downside for things like the dollar CAD. So with all of these things aligned, the only thing we need right now for more downside in the pair is the right catalyst or the right fundamental trigger. So on a solid miss in US CPI, if we get one, looking for numbers fairly close to these estimates in terms of both the core as well as the headline numbers, that could give the pair enough reason to finally break and close below that very tough support level, sitting around that 143 level. So if we do get a solid miss in CPI, it could give the pair enough momentum to finally push lower and revisit those prior swing highs going back to November's high, sitting at the 142 level. Furthermore, that also has some decent confluence with the 1 week implied volatility option support barrier sitting around that 141.50 psychological. However, there's also additional risks. We do have the semi-annual testimonies coming up from Fed Chair Powell, as well as the ongoing tariff saga, which can of course create some two-way volatility for the US dollar. So that's definitely worth just keeping on your radar as well. So with that said, good luck for the week ahead, and as always, stay nimble and trade safe. Also, on a side note, if you guys want a video of a possible game plan for the euro this week with the ongoing potential tariff announcements, just reply to this video and let us know.